Thank you for joining this webinar from Yellowstone Advisory. Today's company presenting is Trident Royalties. Let me now introduce today's presenter. We're really pleased to have with us Adam Davidson, CEO of Trident Royalties. Thank you for joining us, and I look forward to your presentation.
Perfect. All right. Well, I'll try to keep the run through the slides pretty brief, or as brief as I can here, so we can get to the Q&A, because I think that tends to be most beneficial for everybody. Standard disclaimer here: this is the corporate presentation that's on our website, so you can pull it up there and read that at your leisure. Quick overview. So Trident Royalties, we're an AIM-listed company, listed on AIM in June last year, so fairly young company in many respects. Our strategy, which I'll delve into in more detail in a moment, is to build a diversified portfolio of mining royalties, such that we're giving investors exposure to the mining sector from a royalty perspective. And there's quite a few benefits to getting your exposure through royalties, which I'll talk about. When we listed, we had just one royalty. We've now got 13 royalties, a couple of which are paying, and a third should turn on before the end of this year. So we're making good progress. And when we first started, we just had a single iron ore royalty. Iron ore is a good commodity, feeds into the steel industry. But since that time, we've added gold exposure, copper exposure, and lithium exposure. So getting much more sort of base metals and battery metals bent to the portfolio, and continuing to look to expand on that, of course. When we listed, we were at 20p a share. I think we're sort of bouncing around the low 40s at the moment. So we've seen the share price perform well, which is obviously important. Equally important, we're seeing good liquidity. We're getting the word out there on what we're doing. It seems to resonate with investors. So I categorize us as we're very much sort of through that proof of concept phase, and now it's sort of continuing to look to build out on the platform. But let me take a step back and just briefly discuss royalties, because I'm sure not everybody's familiar with it. What you probably have heard are music royalties or movie royalties, where the artist or the creator of that content gets paid when the content is used. And a mining royalty is very similar in the sense that as the holder of the royalty, Trident gets paid when materials or minerals are mined from the underlying assets. And typically these are created as a means of financing. So a mining company will need to raise capital. They may look at the debt markets, they'll look at the equity markets, and then they'll consider a royalty or a stream as part of that financing. In fact, you'd be hard pressed these days to find a mining company CFO that doesn't consider a royalty as part of their financing package. And the reasons for this are pretty straightforward. I haven't met a mining CFO who doesn't think that their share price is undervalued. So a royalty allows you to avoid some equity dilution. But unlike debt, we only get paid when they're generating revenue. So it's covenant light in that regard, whereas a debt facility has a fixed payment schedule and coverage ratios that need to be met. So it's got this nice snug spot between debt and equity that makes it an increasing component of the mining finance landscape. And if you look at the totality of mining royalty companies out there listed in public exchanges, you're somewhere between 60 and 65 billion in market cap. So it gives you a sense that this is a pretty substantial sector within the mining finance landscape. Now, the benefits to royalties for the benefit holder, Trident in our case, is that you get exposure, obviously, to the revenue of that asset. So most importantly, your exposure is limited to the top line of the P&L. So if costs blow out for a given quarter or a given year, that doesn't impact us, or only in a binary sense, that if the costs blow out and the mine is no longer economic, obviously the mine would shut down in due course. So you have to be selective in where you're getting royalties. That said, you're not exposed to the same level of volatility, because obviously equities exposure is the bottom line of the P&L, the profit line. So they're exposed to capital costs, to operating costs, and you can have a scenario where the commodity is performing well, prices are up. The operations performing well, production is as scheduled, but you'll have a disappointing quarter or a year because of these costs. There's a need to expand the fleet or a need to do a pushback on the pit, and these sorts of expenses that hit equity do not hit the royalty holder because we're just getting our percentage of revenue. The flip side is when things are going well, which is why you'd invest in mining equities. The royalty enjoys the same sort of upside exposure in that if the price is performing well, you're getting more revenue. If the operation's outperforming or they've had exploration success, and they've increased the throughput rate or they've extended the mine life, again, all that is covered by the royalty as well. So you get this really nice blended risk return profile that gives you this upside exposure, uncapped, similar to equity, but some downside mitigants. And then layer on top of that royalties tend to run with the land, depends on the jurisdiction, of course, but they tend to run with the land, which means that once the royalty is put in place over a certain mining license or a tenement package, it's there forever, and the operator could actually go bankrupt, but the royalty does not go away. Once it's registered over a given property, it's there forever. And in addition to that, royalties tend to rank senior to equity in that, usually security-wise, they tend to be sort of alongside mezz debt, and we've got a mix. We've got some that are unsecured, and then we've got some that are senior secured, such that we have full security over the entirety of the project. So you get this mix of a superior sort of financial instrument that gives you that good upside exposure, risk mitigated type of platform, and then on top of that, you can build up a portfolio of these. So unlike a junior miner where you've got sort of one project or maybe two projects and you're trying to advance them, but you're highly exposed to that single asset risk. If something happens on your operation, a wall failure, for example, you could be toast from an equity perspective. Whereas a royalty company, as I said, we've got 13 royalties looking to add to that. So obviously we don't want bad things to happen to the underlying operations, but you're inherently diversified, so you mitigate some of that risk. And the final thing I'll comment on this slide is that because we're not operating the mines, it's a very scalable business from a G&A perspective. We've got four full-time employees. As you look to grow, you'd potentially expand out, get an in-house counsel, that sort of thing. But I always reference Royal Gold, which is a New York listed gold-focused royalty company based here in Denver, and they bounce around sort of $7 to $8 billion market cap. And I think their most recent presentation cited 26 full-time employees. So it's just a very scalable business, and we're starting to see the early benefits from that. So then flipping on to what we're doing that's slightly different from others, I suppose, a pretty critical consideration, because I did mention there's sort of 60 to 70 billion in market cap out there in the mining royalty sector. So a natural question then is, well, what's Trident doing differently? And I think it's really summed up by those two sort of donut charts on this slide. The top chart shows the mining sector by total revenue. And these numbers obviously ebb and flow, but by and large, you see it's roughly a third with regards to base metals. So, your nickel, copper, zinc, the bulks and battery metals, and then precious metals, gold, silver, PGMs. But the mining royalty sector is that bottom donut chart. And what you see there is there's a couple single asset royalty companies. So there's a couple big boys that have one single royalty and effectively are just a pass-through dividend vehicle. So if you kind of park them to the side, then it's almost entirely precious metals focused sector. So you've got almost the entirety of that 60 billion in market cap focused purely on that 27% of the global mining sector. And the rest of the sectors, by and large, untouched in terms of diversified mining royalty companies, less than $1 billion in market cap currently out there today. So that was really the opportunity that we're looking to exploit. And then I think, go into some of the assets we have today, but I think we've now got that enough critical mass that you can point to that and say that opportunity is out there. When we first started, there were question marks. Is it not being exploited for some reason? I think we're demonstrating that's not the issue. And then the other aspect is almost all of our peers are TSX listed in Canada or in the US, and they're by and large focused on assets in the Americas. They will sort of venture further out, and as precious metals get a bit more competitive, you've seen that a bit more and more. But by and large, they're shooting for lower return hurdles, assets ideally in the Americas, and they're a perfect world in North America. and it's a fiercely fought over sector, whereas the rest of the sector is by and large wide open. And really that was why I joined Trident. I was at a mining private equity fund prior to that. We wrote quite a few royalties ourselves, and we sort of left scratching our heads at times when it came to monetize those assets. There just wasn't a natural holder of these non-precious royalties out there in the space. So that's the strategy in a nutshell. And I think what you see on this next slide then is our path since we've kicked into launching the platform. So since June, basically 2020 last year, we launched with that one royalty. We're now up to 13 royalties. The yellow bars on there, you can see our liquidity, and that's starting to pick up momentum, particularly after our big acquisition of the Thacker Pass lithium royalty in March earlier this year. We've seen quite a pop in our liquidity, and it's part of just the natural growth of a company. As word gets out there, people get familiar with the story. Events like this, you see improved liquidity, but we're now trading enough that an investor can get in, they can get out comfortably. It's become liquid enough that we've got sort of that healthy trading, daily trading balance. So that's been an important consideration, of course, on top of share price, which has performed well as well. And it's probably not lost on people that a lot of this the share price re-rating is initially driven by your acquisitions. As we announce deals, we'd see a share price response off the back of that. Now we're at the point where there's enough value in the portfolio that as assets are progressing, you're also seeing value increase as we put out announcements on the existing portfolio, because that's a key consideration of a royalty portfolio. Once you have a royalty over an asset and it's in place, and then that asset improves, you should see that improvement re-rated in the stock price. And a good example is our Thacker Pass royalty had a great announcement for us a couple of weeks ago, and that day we were up sort of 8 or 9%. And there's quite a bit of re-rating news that we see coming down the track, which I'll talk to in a minute. Nevertheless, I said most mining companies consider their stock undervalued, and we're no different in that regard. The mining royalty sector, given the inherent benefits of royalties, the diversification, all the stuff I talked about, they tend to trade at premiums to mining companies. So you can see there, junior royalty companies, mid-tiers, and majors. The majors in particular, when you get big enough, they traded at almost 2 times NAV, and at times have traded upwards towards 3 times NAV. So we're still working our way up towards that. But I think the important consideration here is that obviously with each acquisition, we're doing accretive acquisition. So you see the NAV per share increasing with each deal we do, and with the progress of each asset as they make good progress forward. But then on top of that, you get this entirety where the whole company with each deal is starting to re-rate more towards a junior, and in due course more towards a mid-tier valuation multiple. So you get this sort of double kicker. Each deal you do should be obviously accretive in its own right, but then as the entire portfolio starts to re-rate, you get this sort of extra kicker with regards to valuation. And we're starting to see that, particularly some of our portfolio assets are reaching some pretty material re-rating milestones. More revenue anticipated to increase as more and more assets turn on. It allows you to go out there and do things like get lower cost leverage, which we've told the market we're working towards. You can do a dual listing if it's accretive. Most importantly, you can get line of sight on a dividend. So it's those sort of accretive events that lead to this re-rating, and that's what we're working towards. It all starts effectively with the portfolio. I won't go asset by asset, but I thought it worthwhile to talk through a few of the assets. I did want to leave as much time as possible for questions, but I will touch on a few of them, particularly some of our key assets, because I think what we've seen, particularly this past quarter, and really quite a bit over the last month, is some good re-rating events on our current portfolio. I've mentioned Thacker Pass just briefly, and I'll go into it in more detail in a moment with regards to the underlying asset. But Thacker Pass is a lithium project located in the U.S. It's the only major permitted lithium project in the U.S. And the operator, Lithium Americas, has raised the money for construction. They've got the permit. They're facing the final challenge for the permit, which is the routine. The permit gets issued. There's one last chance for people to challenge it. They can no longer challenge on the merits of the permit. They can challenge the permitting process. Something was missed. We're very confident that that's not the case. And once that gets affirmed, which Lithium Americas has said is sort of scheduled for first half of next year, I think February, then they plan to commence construction first half of next year. So that will be a very material re-rating event. On top of that, they plan to issue their definitive feasibility study within the next few months, early next year. And again, that should be an opportunity to get more clarity on the project. And they've already alluded to an expanded production profile off of what the previous study had indicated, the potential for a hydroxide conversion plant, which gives them the nimbleness to deliver into different markets for battery production. And they flagged the likelihood of partnering for development. We don't know if that means, with a battery manufacturer, with a downstream auto manufacturer, they're just down the road from Tesla's Gigafactory. So it's those sorts of things that we know are in front of this project, and the sort of announcements that we can look forward to. And you can do so as a royalty holder. It kind of comes back to the fundamental value of royalties. If you're an equity holder in Lithium Americas, you've got a lot to look forward to as well, but you are exposed to that volatility. And if ramp up is delayed or there's cost overruns, that sort of stuff, that hurts equity value. Whereas the royalty holder, we're sitting there, we've got a royalty over the whole project, plus a 2-kilometer area of interest around the project. So if they expand the project, our royalty expands with it. And it's a 46-year mine life as it stands today. So, a year of sort of delayed ramp up, something like that, you can comfortably wear that because it has a very immaterial impact in your ultimate return profile. But that's an example of some of the positive progress we've seen on our biggest portfolio asset. And touching on a few of the others, because I think it is worthwhile, because this is a portfolio and that value inherent in the portfolio is critical. The Mimbula copper mine, we receive royalty revenue from that asset as of today. It's been paying now for over a year. They recently, I guess a couple months ago now, raised 73 million in equity to expand up to a 30,000 ton a year production profile. And then S&P has reported that they're nearing a debt financing for another sort of $60 to $70 million ticket, which would see them sort of fully funded for that 30,000 ton profile and on track for then a 50,000 potential profile. So, and those are profiles that were higher than what we were modeling when we did the deal in June last year. So again, it's the benefit of a royalty. As they're raising money, we're not diluted. We've got a royalty. It's registered over the whole Mimbula project. It's producing today. We've got a minimum payment schedule. So it pays a minimum of 1.5 million this year and 2 million next year, and it maintains that minimum payment schedule until we're fully repaid our initial investment amount, and then it just flips to the royalty rate thereafter. But an example of a good project, nearly 100 million tons at 1% copper, led by a very seasoned management team. They're looking to IPO in London first half of next year, which will increase the familiarity of the London market with the project that we have a royalty over. Just these nice events that you can see coming down the pathway. So it's again, another example of quality royalty within the existing portfolio. We'll talk on Lake Rebecca, which is a gold royalty we acquired in Australia. That one's been exciting. It's a good asset. We knew that when we got into it. But now it's being bid on by 2 mid-tier producers in Australia. So that would take it out of the hands of Apollo Consolidated, the current owner, which is an explorer, and they've done a very good job, and they're kicking into studies, and it's progressing. They had targeted first production in 2023. But if it can change hands from Apollo to one of these mid-tiers that are bidding on it, one being Gold Road and the other being Ramelius Resources, that's a great outcome for us. The most important thing, I think, with both of those names is that they've got operating assets, but neither has a very clear, definitive next asset on deck, so to speak. So Ramelius has 2 sort of operations, but no real pipeline in terms of new projects that to turn on and continue to expand their production profile. Gold Road is similar. They've got a 50% ownership in an operating mine, but they don't have sort of a next on deck project. So Lake Rebecca would clearly be, for either of those, the next project that they're going to develop. And so it just takes it out of the hand of an explorer that would need to go out there and raise money for construction, puts it in the hands of well-financed plus billion-dollar Aussie market cap companies. Both have no debt. Both have plus 200 million in cash on the balance sheet. So that's the kind of acceleration event. And to put it in perspective for us, when we originally did the deal, we were erring on the conservative side with what we had in front of us at that time with regards to the resource, and we're sort of thinking about an 8.5-year mine life and a 90 to 100,000 ounce a year production profile, with the understanding that there's scope to increase. And then in Ramelius's bid, they flagged a 10-year mine life at plus 100,000 ounce production profile, and I'm sure there's still continued ability to increase there. Otherwise, they wouldn't be acquiring the asset. So it goes to show that the value inherent in these royalties continues to expand long after you've acquired them. And then the final one I'll mention is Koolyanobbing. This is our iron ore royalty. It's been a good acquisition for us. It was our first royalty, so it's got a special place in our hearts. We bought it for 6.65 Aussie dollars. It's paid back more than 40% of that today. It is very volatile. You may note that this last quarter we didn't get a payment. That said, Mineral Resources, the operator of the asset, flagged in their quarterly that they've now moved back into our royalty zone. In particular, they've now started exploiting a new pit that's entirely covered by our royalty. It's got a 3.9 million ton resource. We knew it was there, but had originally excluded it from our economic analysis. We were focusing primarily on the operating pit. But with them moving the mining fleet to that new deposit, it effectively pulls forward cash flow that we weren't expecting. That even if they mine circa half of it at today's iron ore prices and the discount that MinRes gets on that quality material, that would more than pay for the acquisition of the entire royalty. That's not even counting the main pit that we were buying the royalty for. So again, it goes to show the benefits of royalties. So hopefully that's sort of sunk in, I suppose. And what you can see here is our revenue profile. This is the broker's consensus estimates. You'll see there's a one-off sort of real spike in payment in 2024. This is associated with Thacker Pass has a buyback, right, where they can partially buy down the royalty. We assume that this will happen because it knocks the headline royalty from 8% to 1.75%. So that's a big number with regards to the revenue that they'd be producing when they're in production, and all their study work assumes that it would be bought down. So that means that we get 13.2 back in 2024, which is when they anticipate first sort of full scale steady state production. There's a potential we could pull that forward. But to put it in perspective, we paid 28 million for that royalty. We'd be then on risk for 14.8 million once we get back the partial repayment. And at the upsized production profile that they flagged a couple weeks ago, and at today's spot price, that royalty would be paying 15 million a year to us. And again, 46-year mine life, so a pretty astounding return. And obviously, spot prices will ebb and flow over the course of the mine life, but it goes to show you the sort of exposure that we've been able to get into the portfolio. And really, our prerogative from here now is to continue to flesh out the longer dated. We like having a revenue profile that's moving up and to the right, but we also want to bulk up 2022 and 2023. So that's been quite a bit of our focus here over the last few months in particular, and making good headway in that regard. I think this graphic really kind of demonstrates the value of royalties. You get them at a lower value if you're buying them in sort of feasibility, or even construction stage, and then higher value when they're in production. So that's that re-rating that we're seeing as our portfolio. And almost all these names on here, since we bought the royalties, they've shifted to the right, and that they're moving towards production. And that's what we need to see, because it's easy to go out there and acquire a large number of royalties. There's a lot of royalties out there, thousands of them, but many of them are over properties that aren't being advanced. So, all the headlines are nice to do deals, and people like seeing that. What we don't want is any sort of zombie royalties that aren't actively being progressed. Even our smallest royalties are being progressed, and that's really the key for us. So we want to continue to see that, and as I mentioned, we want to flesh out those that are in the production column. We've got a couple deals we flagged under exclusivity. That doesn't mean they'll get done, but they are making good progress. Because it can be quite a tricky thing to get an asset that's in production, but get it at good value, because we've got a portfolio target of 15% post-tax IRR or higher. And so far, we've always been able to meet or exceed that. And And it's blended. Some deals could be lower than that. Some deals obviously going to be higher than that. So getting that on production or very near production assets is what needs to be carefully considered, because what we don't want to do is go out there and pay full value for a producing asset, but not actually get any accretive value per share for Trident. So that's been our focus. An asset like Thacker Pass is sort of ideal in the sense that when we acquired it, it was permitted and funded for construction. It was an existing royalty, so it had been in place for some time. We knew it was out there, but once it passed those 2 key milestones, that was the opportune time to acquire it. Once it has that pretty clear pathway to first production, it'd be great if it was producing today, but it is sort of 18 to 24 months out. That said, if we were buying a royalty today that was spitting out 15 million a year, you wouldn't have gotten it for 28 million. So it's those re-rating events that will be reflected over time in the share price, and I think you're starting to see it reflected as we go. I'm sure some of the questions will touch on pipeline, so I may leave some of that discussion for that. It tends to be a question that pops up. Suffice to say, we do have quite a few assets that we're looking at the moment. It tends to be dictated by the market to a certain extent. There are 2 pools of royalties that we can look at. There's existing royalties, which has been the bulk of our acquisitions to date. Of the 8 acquisitions we've done, 6 of those are on existing royalties, 2 are writing new royalties. The nimbleness that it gives you, though, is you can bounce back and forth between cycles, because as you can imagine, when mining equities are hot, there's less of a need for primary financing of royalties, and you can focus more on the secondary market, or you can pivot back and forth as the market suits. Similar with commodity. I flagged that the strategic opportunity for us was that the non-precious sector is largely untouched by this business model. So we do pick up gold royalties when we see value there. What we won't do is compete with the Canadians to pay full value. So we'll pick up the occasional gold royalty when we can. That said, we don't have a gun to our head. If the value is not there in a gold royalty, then we can pivot to other commodities. And if a particular commodity is running really hot and the value is just not there, then we've got dozens of other commodities we can focus on within the mining sector. So it's that sort of nimbleness that really makes for a pretty flexible business model. And I don't typically talk about the team too much, but I think it is worth flagging, particularly if people are new to Trident. We all effectively have mining private equity backgrounds, have been in the sector for a long time in the mining finance side, all have technical backgrounds to varying degrees as well, and a pretty good team that's spread out throughout the world and have worked closely together in the past. So I think we've been able to demonstrate to date that we're able to execute on good deals. We've got good relationships within the industry that are uncovering opportunities that probably wouldn't be there for many of our peers. And similarly, the board, we've had some changes this year. I think what you're seeing is we're attracting the notice of some pretty high caliber people. Paul Smith joined our board just a few months ago. He was most recently the head of strategy at Glencore, the sort of 50-60 billion market cap major. And he brings some instant credibility. He was also previously a fund manager at Marshall Wace in the UK. So, those touch points with the institutional investors, knowing what they're looking for, the instant credibility to open doors, particularly to some larger transactions, has really been helpful. Similarly, Peter Bacchus joined our board in August this year, pretty well known at head of Bacchus Capital, an M&A advisor focusing on the resources sector, in particular mining in the UK. So he brings a lot of expertise and experience in capital markets, which has been very helpful. Probably also worth flagging, actually, that Paul, Peter, and Al all bought on market in August, which was our most recent open period where we could buy on market. And I bought on market twice this year as well, and have participated in every raise. So we're all in on the Trident story. And thus far, it's been playing out well for us. We've seen the share price, as I said, sort of re-rate from 20p at IPO up to sort of 41. I think we are today. We've still got plenty of cash in the bank at 14.4 million. We've got a healthy pipeline, a lot of opportunities that we're grinding away on, and fingers crossed, we'll hopefully have some news for you before the end of the year. We've been able to bulk up the register, which may be the final thing I'll mention. When we launched, it was a lot of resources, focused funds, a lot of them out of Australia, that know the sector, understood what we were doing. And more recently in the most recent raise we did in March, we got the likes of Amati on the register and a couple other UK funds that are sort of just below the 3% shareholder threshold. So can't disclose their names, but some of these good generalist funds I think are well known to people in the UK. They got a toehold position because they can see that this is a platform that can grow, that is built for dividends at the end of the day. That kind of platform suits their positions well. So I think we're feeling pretty confident with the institutional backing that we have, and we're getting increasing pickup from retail investors. So with that, it's been 30 minutes, and I think probably an opportune time then to shift to questions.
Brilliant, Adam. Thank you very much for that clear presentation. And yes, we'll now shift over to Q&A. And just as a reminder, if you'd like to ask a question, please type it into the Q&A box at the bottom of your screen, and we'll try and cover as many questions as we can in the time. So let me kick off with a question which was sent in ahead of time to give people an opportunity to type their questions in. It's quite a long question here, Adam, so just bear with me. In the 10-month period from admission onto AIM in June 2020 to the 19th of March 2021, Trident acquired 9 royalties. However, in the 7-month period since the 19th of March 2021, Trident has only acquired 1 royalty, which at $2.5 million was very minor. We've heard extensively from the CEO about the 9 active NDAs and the 2 exclusive negotiations and the increasingly amazing pipeline of deals. But why then are Trident now struggling to get any acquisitions over the line?
Yeah, I suppose I wouldn't describe it as struggling to get acquisitions over the line. First off, it probably isn't lost on people that mining equities went for a run earlier this year. Valuations were puffed up, and I suppose what it really circles back to is we're not going to do, we all like announcing deals, and that's exciting, but what we're not going to do is announce a bad deal just for the sake of a headline. So we do want to be judicious in how we're deploying capital. And when the sector's hot, then it's sort of a natural time to cool down for us. And then we've sort of seen that come off, and now we're busier than we've ever been. And we're pretty flat out working on the pipeline. So I think it's a natural sort of ebb and flow that you see in the sector. It's probably worth mentioning too that the sort of the volume of deals isn't really the critical piece. Last year we deployed less than 20 million in capital, mixture of equity and cash. This year we've deployed over 30 million. So yeah, lower number of deals, but larger, more accretive. It's that kind of stuff. And clearly we're shifting to bigger deals. Last year, a lot of our deals were sub $5 million. The Thacker Pass deal earlier this year was 28 million. And although Seduley was only 2.5 million announced beginning of September. That said, the cash flow profile that we put out there in the public domain is our anticipated cash flow projection from the royalty. I think what you'd find there is a lot of our precious focus peers would be paying sort of 10 plus for an asset like that. It was a lot of work because it was a lot of technical stuff to unravel. We worked closely with the management team. I went to site with consultants. We really had to burrow in to get there, and we got it done. That said, it's I wouldn't take the headline value as ascribing that as the actual value of the royalty. I think there's a lot of value there.
Okay, thank you. I'm going to jump to a question which sort of linked to the answer, or part of the answer you gave then, which is, how do you go about due diligence, the technical, the permitting, etc., on projects, especially for lithium and other metals where processing technologies are less clear cut?
Yeah, no, that's a good question. I'll use Thacker Pass, the lithium one, as the example, given that was referenced. So for permitting, for example, we had a review done by Holland and Hart, which is sort of the go-to mining law firm in Nevada, where the asset's located. They're familiar, obviously, with the U.S. permitting process, as is the Trident team from previous experience. But getting their review of permitting was obviously a critical diligence item for us. On the processing side, we went to a group called Implan, which is sort of the sort of go-to, I suppose, for metallurgy when it comes to lithium projects. Given this is a clays deposit, slightly different from the hard rock and the brines, so needed to have that reviewed by a specialist that understands that technology in detail. So it's that sort of process. As I said, we've all got technical backgrounds to varying degrees. So we can do enough damage on our own to sort of review assets as they come in, determine whether it looks like there's something interesting to pursue. But then when you get into the burrowing into the detailed diligence, that's where you do need to tap into the expertise, because we can't know it all. And you look at our Mimbula royalty in copper, for example. We've done a lot in copper. Tyron Reese, our colleague down in Perth, has worked in multiple copper commissionings. So he's a metallurgist. You can look at this stuff and form a view. That said, Mimbula is located in a sandstone hosted copper deposit. It's really only found in Zambia and sort of legacy stuff in Europe. So it's that sort of specific expertise that you're always going to need to tap into. So, but that's generally the process, is we do an initial review, and then we get the right expertise that we need.
Okay, thank you. And just staying on Thacker Pass, when do you expect to receive your first royalty payments from the Thacker Pass project?
Yeah, so we're guided by the operator in this case. We don't have any inside knowledge on that. They flagged, coming to market, as he said, in 2024. It's roughly sort of an 18 to 24 month construction timeline is what they flagged in their previous study work. We'll see what the updated DFS holds. But that would, if they're kicking off in the first half of next year, which was what they publicly stated, that would put them on track for 2024, where they're sort of, you'd be hopeful that they'd be hitting steady state production for phase one by the end of that year. That said, they're also flagged in the most recent announcement that they want to have their pilot plant up and running by the middle of next year. So it depends how they use that pilot plant, the size and scale. The real revenue would be coming when it turns on in 2024. That said, if they're selling material from the pilot plant, then we could see some revenue off that. But by and large, the main core part of the project kicks on when phase one turns on in 24.
And staying with the royalties that are paying, how many of the royalty assets at the moment in the portfolio are actually paying any sums to Trident?
Yeah, so we've got two royalties that are paying at the moment: our copper royalty and our iron ore royalty. And then the Lincoln Gold Mine is, just spoke to the CEO of that project, and they're still anticipating first gold in December. It'll be sort of the first pour, so it's not going to be a massive check, but shows that the project's turning on, and that will be a producing royalty at that point in time. And then we've got our Warrawoona royalty, which to be crystal clear, isn't over the entire project, but that project is in construction. And the most recent filing by that operator flagged that our tenement would go into production in 2023, and has, I think, 138,000 ounces located on our tenement, and pretty much all the exploration upside. So you can see that one turning on in 23. Then Lake Rebecca Gold I'd flagged is planned for 2023 as well. Thacker Pass 24. So you can sort of see this building revenue profile. So with each sort of passing year, you get more and more assets turning on.
Okay. You talk about a diversified portfolio and exposure to multiple commodities, but you exclude coal. What is the reason for not seeking royalties in coal?
It's multifaceted, I suppose. A lot of it comes down to there are quite a few pools of capital that have ESG constraints, and they cannot invest in something that holds coal exposure. So there's a pretty practical limitation there, that we close ourselves off to sources of capital, institutional investors that wouldn't be able to invest in Trident if we held coal royalties. The other consideration is that companies with heavy coal exposure tend to trade at a discount because of the sort of long anticipated phase out of coal, and the fact that you get dinged by investors for holding coal exposure. So as I talked about the re-rate of the portfolio, you want to grow to being valued at 1x NAV, net asset value, and then increasing to 1.2 as you become a mid-tier, and 2x as you become a major. Coal is a drag on that. So even though you could have a single great coal royalty, and it may be very accretive on sort of a standalone basis when you're looking at it in the Excel spreadsheet, if it's dragging down the entire valuation of the company, then it may actually have a negative impact. So for that reason, we've chosen to exclude coal from our target list.
Okay, got a couple of questions here which I'm going to group together because they're related. The first one is, how do you calculate the value added on an acquisition? And presumably you only buy royalties at a discount to their intrinsic value. And the related question is, the NAV you refer to based on a discounted cash flow model? And if so, what approximately is the average discount rate do you use?
Yeah, so I mean, in terms of modeling these things, it's actually pretty straightforward. In fact, everybody sort of at home could probably pull it up and do it themselves. When you look at take Lake Rebecca, it's, Rumelia stated they'd be looking to make this a plus 100,000 ounce a year producer. So 100,000 ounces times whatever gold price forecast you want to use, and we get 1.5% royalty, so we get 1.5% of that revenue. And so you basically model out this stream of cash flows, and then you can sort of bring that down to a present value, what it's worth today. And then obviously, as the question stated, you're not paying full value for that. If it's valued at sort of 1 times NAV, you're looking to pay as little as possible, obviously. For something that's very early stage exploration, that can be as low as 0.1 times NAV. And so you see it, re-rate as you're moving closer towards production, towards being valued at a 1x. That's sort of the name of the game. And then when you're buying producing royalties, I think what we've managed to do is to get those at pretty reasonable values. Of our producing royalties, they've been sort of 0.6 to 0.7. So again, that's really the name of the game, though, is buying these things as cheap as you can, and making sure that when you are modeling it, that line of sight on revenue is pretty clear, such that you're through things like permitting and financing for construction of the project, and that the operator is a good operator that can move it into production in a timely manner. All that kind of stuff is the underlying assumptions that when you're taking that cash flow profile, that means that it's a real profile. It will be realized. And then the second question with regards to discount rate, it's a few factors. The jurisdiction, clearly you don't model Zambia the same as Australia, for example. Also commodity, exchange trade commodities, you can use a lower discount rate versus sort of non-exchange traded commodities. So a long-winded way of saying you'd value gold in Australia differently than you would an industrial mineral in Africa, for example. So we don't have a single discount rate that we use, but it tends to be in the sort of 8 to 12% range, depending on the asset.
Okay, thank you. I see here you've got some cash of about 14.4 million. You've obviously used up cash as you've invested in the royalties over time. Do you anticipate raising more capital to expand the portfolio? And if so, what sort of amount and what will be the timing of any raise?
It's kind of all dictated by the deals. It's probably worth flagging that I think all of us sort of took pay cuts to join Trident. We're exposed through some options to the company, and so we're all equity focused. At the end of the day, we're not rewarded unless the share price moves up. So getting bigger for the sake of getting bigger with the share price just sort of running flat, that doesn't do us any good, and that's not what we're looking to do. So we are very much aligned with shareholders that if there's a raise, it has to be for an accretive deal. It has to unlock value for existing shares. So I can't sort of give a definitive how much we'll raise or when we raise it. Clearly we've been able to tap into the debt markets. We started with this $10 million facility with a credit fund. We're working on shifting to a bank debt, lower cost of capital, and ideally a larger facility such that we can continue to do deals. And if an equity raise is needed, you're sort of minimizing how much you're raising. We want to keep dilution down, rely on debt. And this is a business model that's just built for debt because it's, as I said, it's inherently diversified. You're getting cash flow from multiple assets, multiple commodities. Banks love to lend against something like that versus a miner with even 2 or 3 mines. That's a much higher risk profile for them relative to a royalty company. So we're working hard to make that transition now.
Okay. Got a couple of questions here on the dividend. One is very straightforward, can you tell us your dividend policy? And one a little bit more detailed, at what time would you expect to begin paying dividends? And what approach to this, i.e. would you pay a percentage of your post-tax profits? Would you target a particular yield? How would you compare it to a 10-year bond?
Yeah, it's a pretty timely question because we're actually doing some of this work right now, and it kind of feeds into some of the deals that we're working on. That if they can start to provide a clear pathway to a dividend, how we want to approach that. And there's a few factors to take into consideration. So what we're doing is talking to some institutional investors, particularly in the UK, that may not be on the register now because they've got a yield mandate. They have to have a dividend before they can invest in something. but understanding what the detail behind that mandate, does it need to be within a certain range of the FTSE 250 yield, stuff like that. It's that sort of data gathering that we're doing at the moment. To not completely avoid the question, I think what we would likely see is yes, a sort of percentage of free cash flow, something like that is what most peers do. They tend to be in the range of 20 to 30% of free cash flow. We'd maybe err on the conservative side initially. We want to signal to the market that a dividends is the objective, and that's the intent, is to build up cash flow and then let that flow through to investors. Because again, it's a business model that facilitates, as you get diversified cash flow from multiple assets, you can service your debt. You can let some of that cash flow through in the form of a dividend, and you're not really constraining your ability to go out there and do future deals. If you let a few million flow through in the form of a dividend, that doesn't sort of tie your hands. So it's some of that work that's ongoing now, and it's in terms of when we'd actually initiate it, it's going to be by and large tied to the deals that would underpin it.
Okay, thank you. And look, just as a reminder, if you do want to ask a question, please type it into the Q&A box at the bottom of your screen. Looking here at the royalties and how they are structured, how often do you agree to some sort of royalty being capped or reducing royalty as a percentage of royalties as they grow over time?
Yeah, so this kind of comes back. You can structure royalties. They're pretty straightforward instruments. You just get a percentage of revenue in exchange for funding the operator. That said, the nuance behind it, you can sort of make these things look like whatever you want. But as I've said, we put in place minimum payment schedules and everything else. You can make them pretty funky. And caps are not uncommon, where the royalty falls away, ceases to exist once it hits a payment cap. Obviously, we're loath to acquire royalties like that. We certainly wouldn't write a royalty like that. They caps your upside at the end of the day. So that's not what we want to do. And as we're trying to build up a portfolio that can do things like service debt and underpin a dividend, having capped royalties sort of is self-defeating. So that's not something we're interested in. We do have a couple with the step down rate, and this is something that we've used in commercial discussions with counterparties as they're looking for financing. We want to get our money off the table as quickly as we can, so we deploy the capital. We want to get it back quickly, and so that from there on forward, it's all we're into the profit. So we do like a structure where you get a higher royalty rate up front, and then once you've recovered capital, you step down to a more sustainable, longer term royalty rate. And we've done that with a couple of our royalties, and I think it works well. It also is sort of easy to put it to the operators and say, you're telling us that this is your plan and your forecast, so you shouldn't have a problem. With these sort of metrics, they can accept that. Otherwise, they need to adjust what they're presenting to us as their plan. So it becomes a pretty easy negotiating point. So we have built that into a couple of our royalties.
Yeah, if you look at the Thacker Pass structure that you have, that looks like it's a drop down in 2024. Is that something that you progressed or you suggested to the Thacker Pass team, or did they propose that to you as part of the structure?
Yeah, so that one was an existing royalty. It was written back in 2012, so almost 10 years old now. And effectively, the way it was structured, so short answer is no, we didn't put that in place. We inherited it when we acquired the royalty. But the structure was pretty clear. It basically knocks it from an 8% gross revenue royalty. So for every $100 they're generating, 8 would flow to the royalty, knocks that down to 1.75. So that's a huge impact. And effectively, it kind of puts a gun to the operator's head. They have to exercise that. You'd be crazy not to. If they didn't, then that's all the better for us. We'd be more than happy to have that size royalty. But for a well-funded operator, and they've raised $400 million to go towards construction of this asset. They've got another, I think, $200 million in undrawn debt facilities. So to pay that, it's a $22 million headline amount, and then we own 60% of the royalty, so we get 13.8 million of that buy down. The expectations that would be that would be executed. So that kind of structure you wouldn't be averse to, because it does basically pull forward some capital. But most operators don't like it. I think they only got away with it because Thacker Pass at the time was a early stage unpermitted lithium project prior to sort of lithium really getting the momentum it's gotten with sort of the increase in battery usage. back in 2012 is a very different landscape. So you wouldn't get a prayer of getting that away on a good lithium project these days.
Okay, thank you. I think we've got time for a couple more questions. So if you do have a question, please type it in at the bottom of your screen. Looking now at commodities, what's the most important commodity in your portfolio?
Well, that's a tough one to answer, actually, because we like all of our royalties. The Thacker Pass royalty, I think, is hard to pass up those economics. As I flagged, when we did the deal, lithium was at, it was sub $12,000 a ton. And I haven't looked today, but in the past few days, it's been bouncing up towards $27,000, $28,000 a ton. And delivery to China has been $30,000 a ton for lithium carbonate. And that's all underpinned by, the fact that we all see it. I mean, that's why there's interest in this particular sector is, the world leaders are meeting as we speak to push forward these climate initiatives. That all takes, demand for green metals, and then the dislocation that you have, which is not new in mining, is that, the demand can suddenly materialize. Everybody starts buying electric vehicles, but it takes a long time to find a lithium deposit that's economic, advance it through exploration, build a resource model, get through permitting, have a mine design, get funded for construction. That's a multi-year process. Thacker Pass was in permitting for 10 years before it finally got its permit. So demand is a long way of saying that, demand can materialize within a year or two and supply can't catch up to meet it. And that's what we're seeing in lithium. The fact that the US doesn't really produce any of its own lithium, just one small little mine at the moment. And Thacker Pass is the only major permitted project in the US. Most of our lithium comes from Australia, processed in Korea and sent to the US. But auto manufacturers like to be vertically integrated. They like to have control of their supply. They like it to be sort of in the same domestic market. So it's that sort of stuff where there's this value dislocation, which is why there's this hype around lithium in particular, battery metals more broadly. I also like copper. I won't give you the same long spiel on copper, but we're happy to have our Mimbula copper royalty. It goes unnoticed, but our Pucahaha royalty in Peru is a big project being advanced by a New York listed mid-tier operator that builds mines of that size, pretty much one after the other. So I think there's a lot of hidden value there that doesn't get realized by the market, but we're happy to have the copper exposure we have.
Okay, and then again, a follow-up on the commodities. Is there a commodity out there that you would like, you don't have exposure to, but you'd like more exposure to, or is there something in your portfolio you already have some exposure to, but you think we'd really like to get more exposure to that? Is there a particular commodity you're looking to gain more exposure to?
Yeah, everybody has a different answer for this one. I wouldn't mind having more exposure to base metals, in particular nickel. Again, it's used heavily in battery and battery technology, and is a pretty robust, similar to lithium, where it's not really the cost driver of the battery. So in terms of being engineered out, manufacturers are always going to try to minimize the mineral usage, but you can't replace lithium. You can't really replace nickel the same way you can for cobalt, for example. So would like to get some nickel into the portfolio. I suppose that might be first prize. I also wouldn't mind getting some zinc into the portfolio. Really, the prerogative for us is, as I said, we want to build out a market representative offering such that if people say, I want exposure to the mining sector and mining commodities, and royalties are the best way to get that exposure, and Trident is the only one that has exposure to the full mining sector, does precious and non-precious. That's ultimately where we want to get to. So adding more commodities as we go is clearly our prerogative. That said, we're still in the early enough days that we're just going to focus on the most accretive deals we can. So if that happens to be a gold deal, then that's what we'll do.
Great. Adam, thank you very much for that. That sort of brings us towards the end of the time that we have available today. Thank you for that clear presentation, and thank you for going through all of those questions and answering them incredibly clearly. As you exit today's webinar, can I just remind you that you will come to a shorter feedback survey. We'd really appreciate it if you could just spend a couple of moments giving some feedback. I know management find that very helpful when we provide that to them, so please just spend a couple of moments completing those survey questions. And then just to flag up a couple of webinars that we've got coming up in the next few weeks. On the 18th of November, we have Castings presenting following their half-year results. The 24th of November, we have Sainsbury's in a joint webinar with ShareSoc. Then also on the 13th of December, we have Halma presenting in a joint webinar with ShareSoc again. So Thank you very much. Thank you to Adam for presenting today, and thank you for everyone attending, and we hope to see you all soon.